We've been speaking with a new client that's in the middle of their first time fund launch. Fund docs are underway. We're very much getting ready to go out and start fundraising, and we just started thinking about the upper tier documents and how the partners in this business are going to share in economics. We thought that this was a really important time to think about estate planning and how we can meld estate planning thoughts and objectives with our fund documents. What do you typically suggest at this stage?
That's fantastic that your client's thinking about estate planning already at this stage. I think what would be helpful for us is probably a little more detail at this stage.
Okay.
I think things like, does the client have kids? Is the client married or divorced or second marriage? How old is the client? How old is the client's kids if they have any? Things like that will really allow us to tailor our advice to your client's situation.
Sure, hopefully not that complicated. Mid-40s, 2 kids, married, wife is a high earner, but up until this point, there have been minimal assets that they've really thought about for purposes of an extensive estate plan.
I mean, as an initial conversation with them, we'll just really basically want to get a sense of their personal philosophy towards wealth disposition. I mean, we definitely have plenty of clients whose primary goal is to maximize wealth transfer to the next generation and, many generations beyond. But that's not everyone's goal. I've definitely worked with clients that cap kids at a certain amount and give the rest to charity. Sometimes it's done because they want to incentivize the kids to be productive, but sometimes it really is part of a strong conviction that, a philanthropic vehicle like a family foundation is a significant part of the inheritance that they leave their kids. They want to give them that opportunity to consider, philanthropy as a part of sort of like their ongoing lives, and they want to give them the availability of those funds to continue that family legacy.
Sure.
Yeah. And something else that's important to think about are, does the client have other family members or friends that they want to benefit through their estate plan? And then it's also important to really be very transparent with the attorney when talking about your asset picture, because assets like life insurance, retirement assets don't actually pass under the will. And so the attorney is going to want to update any beneficiary designation forms to make sure they're in accordance with the client's wishes. And also, even something like a second residence in a different state can be very tricky to transfer on death. And so by knowing this in advance, the attorney can think about a trust or an LLC or something that would make that disposition easier when a client dies.
So what are we thinking about at this stage in terms of really primary documents, and who are some of the key third parties that this client should be thinking about?
So the basic estate planning documents that your client would want to consider right now would be a will and revocable trust, which govern the disposition of assets at the client's death and can be changed as much as they want. We have some clients that change it monthly,
Weekly,
some years, more so than other years, but they can change it anytime they want. Do you happen to know if the client has a will already?
So they do. They do have a will that was drafted by a friend, and it was really just to address what happens in case of their untimely death and what do you do with the kids. But wealth was not a primary consideration at that time.
We better take a look at that. Sometimes those can be a little bit of a disaster, especially for clients in our space. So need to make sure that it's not an urgent need to revise it. But the will and revocable trust would certainly be 2 of the first documents we consider for them. And then the healthcare proxy and power of attorney. Healthcare proxy is where the client would appoint an agent to make medical decisions if the client can't make them themselves. And the power of attorney allows them to appoint someone who can make financial decisions for them in certain circumstances that might be desirable for them.
Sure, that makes sense.
Right. It's also really important to think about fiduciaries. And the fiduciaries include people like the executor, and the executor is really in charge of the estate administration, the trustee, who's in charge of investment and distribution of assets held in trust for children or for a spouse, and also the guardians. The guardians are the people who would take care of minor children in the event that both parents passed away. And really, the fiduciary decisions are sometimes the most difficult for clients, and sometimes it even impedes them from even finishing their estate plan. But what we like to recommend is for people to really think about the types of fiduciaries they want to name, but they don't have to necessarily be financially savvy. What they really need to be is thoughtful, smart, and know when they need help, and they can hire investment advisors to help them oversee the administration of the estate or the trusts.
Backing up a minute, although the basic documents are really important and will govern the vast majority of a client's wealth at death, most typically, But now at the inception of the fund, they really have this unique opportunity to potentially give to a trust for their kids, grandkids, and future generations if they have the $12.92 million per person federal gift tax exemption available. You happen to know if they've made any gifts yet?
Not sure about that at this stage.
Probably not.
Yeah. Yeah.
So what strategies do we think of at this juncture, whether or not you do have the tax exemption available to you? I know that we have all at one time or another for one client or another, worked with them on transfers of a slice or a proportionate share of their capital interest or capital commitment and carry.
Right, for sure. I mean, that transaction is known as a vertical slice. And that's really where a client is making a direct gift into an irrevocable trust. And they really need to be focused on transferring a proportionate interest of their junior holdings as well as their senior holdings so that they don't run afoul of any IRS valuation rules in the context of making this transfer.
But the straight gift isn't the only option. You've got other alternatives if that's not the right fit.
That's right. That's right. Just in December, I helped 3 different fund clients who had used up all of their gift tax exemption in the past 5 to 10 years. And they were starting a new fund and were interested to see if there was anything they could do to get additional assets out of their estate. I told them that they could actually sell an interest, this vertical slice interest, to a trust, the trust they already created or even a new trust, depending on funding abilities. And the trust would issue a promissory note for the discounted value of that fund interest that they'd pay 10 or 20 years down the line as a balloon payment of principal with annual interest payments until that time. It's a great way for them to lock in the value of that vertical slice interest at a lower rate and pass all appreciation above that to the trust for their kids.
Another option a client could consider is a GRAT, which stands for Grantor Retained Annuity Trust. And in this transaction, a client would transfer a piece of the carry into the GRAT, and the GRAT would pay an annuity to the client annually until the end of the trust term. And that would be when the entire trust principal would be paid back to the client plus a little bit of interest on top of that. And any balance that would be remaining in the trust after the last annuity payment could pass tax-free to kids or to trust for their benefit. So it's a really great strategy for clients to think about. This strategy tends to work best if the GRAT is going to have a lot of liquidity during the term so that there'll be money flowing into the trust to pay the annuity back to the client.
So the other strategy that a fund client might want to consider, especially with a fund that's been very successful and is not at inception, would be a estate planning derivative contract. Just like a derivative contract in the business context, you would set certain hurdle rates for performance and could even set certain caps if they don't want to transfer so much wealth to their kids. And depending on how the fund does, if it's successful enough and beats those hurdle rates, all of that value will pass to the trust in the form of just cash, distributions of carry, for example. They wouldn't actually have to transfer the fund interest to the trust, which can be really helpful if you have very restrictive governing documents that wouldn't allow for those transfers, or if they have partners that wouldn't be comfortable with the trust in being involved in the fund formally for one reason or another.
It's interesting, and it's good to know, right? And this sounds like it's a great strategy for somebody that has some long-standing funds where some of the efficiencies of that vertical slice may not make sense.
Appraisals are key, but I do have to say that, speaking of appraisals, it's helpful for us to know if the client is at all charitably inclined, because you need to coordinate gift and estate tax planning with charitable planning, because as you might assume, right, you want a low valuation for gift tax planning, but if you want a deduction, you want a high valuation for charitable income tax deduction purposes.
The clients always want it both ways.
They want it both ways, and unfortunately, you don't get to play that game. Yeah,
we wish we could do it.
We wish we could, but they've got to be consistent.
Right, which is why some clients decide that they don't want to transfer fund interest to charities.
Right, exactly. I mean, that's a big reason, but not the only reason. It's also just, it's complex, and you need to think it through. Depending on the circumstances, a donation of a fund interest can get you a much lower deduction than a donation of cash or marketable securities. And the other issue we unfortunately come across a lot of times is clients will inadvertently run afoul of some pretty strict rules when they hold a fund interest in their private foundation or donor advised fund, very popular vehicles, but you've got to be very careful. There's self-dealing, excess business holding rules that can trigger really significant excise taxes if you don't pay attention to them. But there's lots of options available. There's a whole spectrum of philanthropic structures, vehicles that we use. it's really just a discussion about balancing priorities. So we get a sense of a client's philanthropic objective, their tax motivation, and their desire to maintain control over the long term. And then there's always trade-offs, but we discuss the trade-offs and find something that's the right fit.
And those motivations change over time.
They do.
Often,
They
right?
do,
Yeah.
definitely. Yeah.
Right. So this seems like a really opportune point to have these conversations because optionality,
Yeah.
it sounds like there's a wide range of things we can consider, but making sure that our fund documents, upper tier documents also kind of meld with these thoughts.
Right.
Exactly.
We wanna have-
Flexibility is key.
Sure.
Yeah, yeah.
Sure.
And yeah, like Brian said, what works now may not work later, but you at least want to know what's down the road so you can kind of anticipate it.
Yeah, and I think you're ready to go back to the client and propose some of these ideas. And if you need us, we're happy to jump in with you, or we can talk again later on.
Yeah, this has been
Yeah.
perfect. Thank you.
Good.
And I think I have enough to at least have a next phone.